Hi, Selva here with another market update. In this week's update, I wanted to talk about interest rates, or to be more specific, about negative interest rates. The US Federal Reserve is most likely leaving interest rates unchanged this year. That's quite a change from last year, when it was looking at increasing interest rates at least twice. Why have they changed their minds? Well, mainly because they're more pessimistic about the economy. They're expecting slower growth this year and next. Of course, the Fed may always surprise us and raise interest rates, but the Fed isn't the only one. It doesn't look like the European Central Bank, the ECB, is looking at hiking rates anytime soon, and the rates are already at zero. Many of the OECD countries like Japan and Canada are also keeping their rates low. In Australia, the Reserve Bank of Australia has left rates at a low 1.50% for months. And while they were talking about raising rates, it doesn't look like it's going to happen anytime soon with a property downturn. Central banks around the world are having a hard time lifting rates because, well, I think it's because there's too much debt around. Higher interest rates will make all that debt more expensive. And while some may be happy about the banks not raising rates, this isn't a good sign. It could mean we're nearing the end of the cycle here and heading towards a recession. Europe is slowing, China's pumping more stimulus to avoid a slowdown. And the thing is, despite what you may hear, our global economy is nowhere near normal. Low interest rates are the new normal. What happens when the next crisis hits? Well, according to the International Monetary Fund, the IMF, crises in the past have required between 3% and 6% interest rate cuts. Yet with interest rates at record lows, most countries today don't have the room to cut rates by that much. We could very well be heading towards negative interest rates. A negative interest rate works kind of like a tax on your money. Instead of the bank paying you interest to use your money, the saver pays for having a deposit. In other words, keeping your savings in the bank means that you lose money. The idea is to get people spending instead of saving. But people have an alternative, cash. Let's look at Germany for a minute. German savers have been keeping their money in the bank for years, even at low interest rates. So when interest rates dropped to negative, German savers said that's enough. They started withdrawing their money from the banks to keep their cash in safes at home. In fact, safe manufacturer sales saw a jump. Cash is cash. It has an interest rate of 0, which is better than negative. So as you can see with Germany, cash restricts how much central banks can lower interest rates. If interest rates go below 0, people will start stashing cash at home to avoid losing money. That is unless things change. You see in a recent blog post, the International Monetary Fund looked at how central banks could make negative rates a feasible option. They could do this by making cash less appealing. How do you do that? Well, as the IMF proposes, you could divide the money supply in two. You could have cash and you could have e-money. In practice, there are two currencies. E-money is only used electronically and pays, let's say, a negative 5% interest rate. You can still use cash, but it has an exchange rate against e-money. Every time you want to deposit cash into your bank account, you have to exchange it to e-money. For every $100 in cash you deposit, you get 95 e-money, so you lose 5% of it. Stores also have two different prices. One is for payments in e-money and the other is for payments in cash. And yeah, paying in cash would be more expensive. So effectively, there is no benefit to people holding cash. It's been interesting economic times since the 2008 financial crisis. We have seen low interest rates for a long time. We could see even more unconventional policies applied when the next crisis hits.